Evening, good afternoon, and good evening. I'm Chantal Carrington, CEO of Invest Africa, and it is my absolute pleasure to welcome you to Invest Africa's annual West Africa Regional Outlook, the second outlook in the series this year. As West Africa enters 2025, the region is poised for a steady recovery, with GDP growth projected to reach 4.4%. This growth is underpinned by ongoing structural reforms, expanding regional integration, and the diverse economic strategies. While Nigeria remains the largest economy in Africa, its expected growth in 2025 is a modest 3.7%, largely due to the ongoing macroeconomic reforms aimed at addressing fiscal imbalances, boosting long-term sustainability. In contrast, countries in the West African Economic and Monetary Union are expected to outperform, with growth rates of 6.2% projected in 2025. Today's outlook will also cover the role of the African Continental Free Trade Area, the green energy transition, and how countries are navigating political and climate risks to position themselves for future growth. There is very much to hone into, and I think we should now move into more of a debate. So I'm going to hand you over to our moderator, Funmi, partner at ALN Nigeria, to introduce you to the speakers. Now, Funmi is part of the banking and finance team there. She has consistently been ranked by international directories and described as an emerging force, solid, knowledgeable, accessible, and exhibiting a commendable level of professionalism. That's quite a mouthful. She's also been recognized in the Lexology Index as a thought leader, and she's also in the Who's directories. But let me not tell you too much about the detail. I'm going to hand you over to her to do that. So Funmi, on that note, over to you.
Thank you, Chantal. Happy New Year, everyone, and welcome to the Invest Africa Economic Outlook for 2025. I'm very pleased to be here, and 2024 was a year that had a lot of activity in the region. So we saw significant and very far-reaching reforms in Nigeria. We saw Ghana continue with its debt restructuring and saw the new elections. And we also saw realignments in Francophone Africa. So the question is, how will all of that impact the economic outlook for 2025? And I think our panel of experts is here to tell us. And so I'll just hand over to the panel to introduce themselves, starting with Razia.
Thank you so much, Funmi. I'm Razia Khan, Head of Research for Africa and the Middle East at Standard Chartered. And just checking if I should launch into my West Africa outlook right now, or are we doing introductions of Tim first?
So we'll do the introduction. So Tim will go, and then we'll just go back to you.
Thank you, Razia. Thank you for me, and lovely to be with you all this afternoon. My name's Tim Cox. I'm the managing partner for Control Risks in West Africa. So I look after our West Africa business based across our offices here in Lagos, Nigeria, and also Dakar, Senegal.
Thank you. I'm not sure if we're having some sort of website issue, but I will just take the brief outlook for West Africa from here. So 2025, as we know, is a year of great uncertainty globally. Markets started the year with a great deal of volatility. We saw initially a reassessment of how much Fed interest rate easing was likely. We're all waiting to see what happens with the political transition in the US. Are we going to be seeing the imposition of significant tariffs on US trading partners? Could China be hit with a 60% tariff on its exports to the US? Could it be 10 or 20% for the rest of the world? Or is that only a negotiating tool to try to resolve the issues around the US trade deficit, current account deficit with the rest of the world? You may wonder, why am I starting with this in an outlook on West Africa? And that is because prospects almost anywhere in the region will depend very crucially on global growth. And the starting point is that it looks as though it may be a difficult year for global growth. Across developed markets, in the wake of the COVID crisis, we saw the kind of inflation rate that we hadn't seen in around 40 years. We saw significant developed market tightening. It may seem like it was all happening some time back, but there's great uncertainty still around the inflation outlook. Whilst we've seen developed markets' central banks starting to ease their interest rate policy, the way ahead is not very clear cut at all. And this stands especially for the Federal Reserve in the US, where there's been a great market reassessment on just how much interest rate easing is likely from the Fed, how quickly that comes, how deep that easing cycle is going to be, and even when we might see the next rate easing in the US. So, with all of this said, what does it mean for the West Africa region? We have seen in Nigeria, first of all, a notable amount of reform since mid 2023. The government of Nigeria embarking on very difficult, almost unprecedented fuel subsidy reforms, and simultaneously proceeding with much needed FX liberalization. I'm certain that many of the participants in this call will welcome the fact that we do now have a more tradable FX regime in place in Nigeria. The old situation where there were attempts to keep the currency stable, unchanged, despite differing fundamentals, never really succeeded in something that would help to draw in investment, because it was so onerous to get over the restrictions around the availability of FX that this did have a significant economic impact. In our view, it was a factor that probably resulted in very little investment going into the region relative to what might have been the case. Of course, the counterfactual is always very difficult to establish. But we have seen this bold embrace of reform. Nigeria now has the most liberalized FX regime it has had at any point in its post-independence history. We know that as of December and the introduction of the BMAT system, further reforms on the interbank FX market, there is now a great deal more visibility on the true extent of FX demand, and we are finally in sight, we believe at Standard Chartered, of seeing relative stability in the exchange rate. A big question that many of you will have is, what is the outlook for Nigeria? We know that as a consequence of the reforms, Nigeria has been left with still very high inflation. We had the release of December inflation yesterday, and that was just under 35% year on year. Transport price inflation from the fuel price increases that had been seen in September and October playing out with the lag, even though there are some early signs that food price inflation may be moderating. We also know that there's going to be a rebasing of the inflation basket in Nigeria. So come the end of January, we should have the release of new data. And with the release of January inflation data, the expectation is that with a lesser weighting of food in the basket, moving from just over around 51.8% to 40% of the inflation basket, all things being equal, we should start to get somewhat more improved inflation data. But as we all know, key to the outlook for the economy, key to prospects for investment, key to prospects for growth in Nigeria is going to be the likelihood that we see FX stabilization. The reason why I opened my comments with what is going on globally is Nigeria's best hope for foreign exchange stabilization still is going to depend on how much foreign portfolio investor demand there is for Nigerian assets. FPI, as we call it, is always a lead indicator of how much longer term, stickier foreign direct investment flows we might anticipate in the economy. And the good news for Nigeria is that the reforms have largely been welcomed by foreign portfolio investors. So whilst other emerging markets with much lower interest rates look like they might have a difficult time of it, given global interest rate volatility, that it might be difficult to attract these flows, Nigeria is in a much better place. The problem, of course, is how long can Nigeria withstand these super high interest rates? And in this regard, I would mention that it's only the nominal rates that are very strong. If we consider that inflation for the moment, our best assessment of it is that inflation is somewhere in the region of 35% year on year, that still means that in real terms, policy isn't all that restrictive. The good news for the Nigerian economy in 2024 was that we've seen some uplift to oil production, albeit still given the constraints of an overall OPEC quota. If we consider crude and condensate production, we look to have reached levels of around 1.79 million barrels per day over the course of December. Now, whether that improvement can be sustained given the overall environment is, of course, going to be a key matter of interest. There's also the belief that a lot of that supposed increase in production may just be the identification of previously missing barrels. And whether Nigeria can attract a lot more meaningful investment into improving its own production capacity at this point is, of course, going to be key to the outlook. But the really important point to remember is that with recent reforms, Nigeria stands its best chance yet of being much more than just an oil economy. This is Africa's most populous country. This is the country where 1 out of every 5 Africans come from. And if you look back at Nigeria's economic history, so much of its growth potential had been held back by this overdependence on oil. The fact that Nigeria has embraced foreign exchange liberalization as it has finally creates a very important precondition for the meaningful diversification of the economy. So whether we see it by way of refining capacity, whether we see much more foreign direct investment going into the agriculture sector, addressing this key issue of food security, which remains so important to Nigeria, at least the macroeconomic underpinnings for any of this to start to happen now look to be in place. I'm sure we'll have a very lively Q&A, so I will leave the Nigeria questions there for the moment and turn to Ghana. Ghana enters 2025 with a new government. We had elections right at the end of 2024, and reflecting back on recent experience, the surprising feature of Ghana's growth in 2024 was that for an economy that had so recently been through a debt crisis and debt restructuring, growth was super robust. Historically, what we've seen around elections is the tendency to see something of a very pronounced election-related cycle, where a lot of the restraint on fiscal policy tends to be discarded, and the year after elections, historically in Ghana, have been a year of fiscal reckoning, a tightening of both fiscal and monetary policy, weaker growth. The question now is, given what we've seen in Ghana, is this really going to be the case? First of all, it is something of a surprise that we see growth as robust as we did over the course of 2024. In part, this was driven by the weak base, but given the recency of the debt crisis in Ghana, it's all the more surprising. We need to look deeper at what was driving that growth experience, whether there had been any additional spending pressures by the government in the fourth quarter of the year. There's very little evidence of it ahead of that. And if that was the case, what does it do to the starting point for Ghana as it looks to deal with the fiscal challenges that are still to come? Now, the key point is that whichever government would have won the election, come 2026, with the nature of Ghana's domestic debt restructuring, they would have faced a really difficult time, because there was a domestic debt restructuring exercise. But the point is, when it comes to 2026, dealing with those renewed domestic debt service payments becomes that much more onerous. Ghana's government has said it's looking to renegotiate its IMF program. The IMF has said it's okay with this so long as the overall macroeconomic stability conditions remain in place. So there are going to be big tests for Ghana ahead. But I think the point we all need to hold on to is that growth in 2024 was surprisingly strong despite the recency of the debt crisis. And if Ghana can just continue with a little bit of that performance, it might be able to establish a sound base for future growth, whatever the debt service challenges that lie ahead. The basic problem, and we don't just see it with Ghana, it could equally be said of Zambia, is that even countries that have been through formal common framework debt restructuring still emerge from these experiences with a very elevated rate of debt, a level of debt. So being able to achieve better rates of growth is the best bet for being able to deal with that level of indebtedness going forward. Finally, just a quick word on Francophone Africa, and I'm sure Tim will be talking us through a lot of this. Francophone African economies remain the relative outperformers in terms of growth. This is partly a feature of the macroeconomic stability that has been afforded to them because of the CFA franc peg. It's partly a feature of the fact that economies like Senegal, like Cote d'Ivoire, for reasons very unique to those economies, have had this strong growth experience. And now we look to Senegal becoming much more of an oil and gas producer. But we also know that the benefits of this growth are not very often evenly realized. And this has led to a great deal more interest in the political trend in the region, which no doubt Tim will be talking about. For investors, for market participants, the key question is, how much is the fallout in terms of the relationship with France? Are these pressures, the disappointment with growth and what it has delivered all along, going to take us in a whole new direction in 2025? And on that matter, I'll conclude my introductory comments. I think we have quite a lot to get through in the question and answer session. And back to you, Funmi.
Thank you, Razia. I'm just going to remind all the people joining us today that they should please put their questions in the Q&A section, but we're already seeing a lot of questions. So we'll go to Tim, who's the geopolitics expert. Razia spoke about the elections in Ghana. There were a number of elections on the continent in 2024. And so what we'd like to hear from you is how you think that those elections, the change in administrations, will impact investments in the region.
Yeah, thank you, Funmi. So I think 2024 is probably best described in electoral terms as a backlash against the incumbents. So we saw several long-standing liberation parties in Southern Africa lose control. And close to home in West Africa, we had a couple of key elections in Senegal and Ghana that both saw peaceful regime change, or relatively peaceful regime change. Senegal was key. Razia has just touched upon the outperformance of the Francophone economies, and Senegal is a leading player within that. The new government, which is much more populist in nature, has taken a clear policy turn away from its previous and long-standing historical alliance with France, which was an alliance that the previous administration championed. They're reviewing contracts across critical sectors, including oil and gas. And this does pose a threat to the nascent oil and gas sector in Senegal, as contracts that were previously believed to be sacrosanct and standing and binding are potentially under review going forwards. And there will be an ongoing question mark as to how the government will interpret its more populist rhetoric and actually implement that in terms of policy on the ground. In Ghana, while very positive news that Razia highlights on the economic front, we actually saw a positive economic outlook irrespective of the winner of the election. But there was clear demand for change driven by widespread frustration amongst the local population with what they'd seen under the previous administration. It's also worth highlighting Nigeria. While it didn't have a presidential election, it was a crucial year in Nigeria's macroeconomic development, as has been previously noted. And we've had another year to experience what those reforms are, how those reforms are going to play out, and the impact that that's likely to have on the investment environment. It's also worth noting that there are a number of elections that were supposed to take place which didn't. Mali, Burkina Faso, and Guinea all at one point had elections scheduled for the previous year. None of them took place. I think two key trends here, which we've seen across the region. So firstly, the lack of the ability of the international community and advocates for democracy more broadly to put pressure upon the ruling regimes in those jurisdictions and press for elections to take place. It also, by extension, demonstrates the lack of accountability that these governments have, and that their ability to act with few constraints, both in terms of their domestic agenda from a policy perspective, but also in terms of their interface with the international and domestic business community. And we're seeing issues with reappropriation of assets and squeezes being placed upon operators in those areas. A couple of key elections to come. So not just looking backwards, but looking forwards. In 2025, we have Côte d'Ivoire and we have Cameroon. And of course, as we move into these election cycles and the pace gathers, we will see increasing focus and interest on those elections, less focus on the business environment. And of course, the threat of unrest and politically related violence will increase and potentially has a disruptive effect upon the business community at large. There's also one other key election, and we'll touch upon this later on, I think, in the US and the impact that the regime change in the US and what that will mean for the wider West Africa economies. But I'll hand back at this point and we'll come on to that point later on.
Thank you, Tim. Actually, it'd be interesting for you to just expand on that point. You've spoken about the new US administration. I think you should also even talk about the increasing role of China in the region and in Africa generally.
Yes, indeed. So I think two key things here. So firstly, US-China relations. We've talked a lot about this split and divide and a question of alignment, whether or not economies are going to side with one or the other and look to extract maximum potential benefit for themselves. We see a very fragmented picture. So whereas some of the Sahelian countries have looked for closer alignment with other regional and international powers, crucially, most of the littoral states in West Africa have chosen a clear direction of non-alignment. They've tried to balance both sides and play off both sides to maximum benefit for themselves, which makes good sense in the increasingly fragmented international environment that we find ourselves in. We see that China is likely to maintain its strategy of extensive engagement across the continent, not just confined to West Africa, of course. That will be in contrast to how we predict the Trump administration will look to engage. Rather, the widespread engagement that we see from China, we expect them to focus more upon specific bilateral relationships where there is a perceived economic benefit for the US and there is a perceived gain to be made in terms of enhanced trade relationships or enhanced military cooperation. We expect to see less appetite from the US to get involved in peacekeeping operations, poverty alleviation operations, and generally to take a more trade and economic focused view as to how those relationships develop. So I think it's a really interesting time. And obviously, as we stand on the cusp of that official regime change in the US, there's a lot that's going to play out over the coming year that will have a significant impact on the region.
All righty. Thank you, Tim. So back to you, Razia. So just like to get your thoughts on, so you've already spoken about the macro and the global economic outlook, but when you now talk about investment opportunities in the region, what do you see as being key?
Thank you, Funmi. So I think there's an obvious focus on the oil and gas sector. Let's start out with Nigeria. In Nigeria, for many years, activity in the sector had been stalled by the time that it took to pass the Petroleum Industry Act. That was finally done, but it came so close to the election-related uncertainty that was facing Nigeria that many participants in the sector preferred to wait until after the elections for clarity on what would be the case. Nigeria's challenge, as much as there's a focus on economic diversification and really making the most out of the potential of for other sectors in the economy, diversification is now something of an imperative, but oil remains the most significant FX earner still. And the big challenge facing the country is in an environment, a global environment that hadn't necessarily been very conducive to attracting new investment in that sector. How is the funding for the new Nigerian companies, many of them indigenous companies who are looking to take over the assets of departing oil majors? How is that trajectory going to look? How easy is it going to be to obtain the funding? Are we going to see a realistic prospect for a rise, a meaningful structural rise in Nigeria's oil production? In my comments earlier, I alluded to the fact that yes, we'd seen production numbers creeping up, but is that just the identification of previously missing barrels? Is it dealing with earlier constraints related to crude theft? Or is it an actual organic rise in production? And what Nigeria really needs to see to be able to turn around its macroeconomic prospects is a little more of that organic rise in production. Now, one of the consequences of the Trump administration is that globally we might be looking at different prospects for the sector. There has, of course, been a significant fall off in US demand for West African crude, given its own rising energy oil self sufficiency. That's not going to be changing very meaningfully in the very near term. But the really exciting prospect for the entire sub-region is that we could see more investment directed at this sector. Agriculture is also another key sector, not least because the food inflation data in the region, and that's not just Nigeria, but across West Africa, tells us that a lot more policy attention needs to be given to this sector. We are seeing increasingly encouraging signs. It's only tentative for now, given the recency of FX liberalization, but signs from major multinational companies that they are increasingly attracted to the prospects in this sector. And there is finally an FX regime in place that might be more conducive to attracting that more meaningful, longer term investment that could raise agricultural productivity. So oil and gas, agriculture are certainly going to be important. And let's not forget banking. Nigeria, with its very ambitious timetable for new banking sector recapitalization, Ghana too having to deal with the banking sector capitalization. I think that's a subsector that will be seeing a great flurry of activity region-wide.
Thank you, Razia. So, I think we're just going to move to the Q&A. We have quite a number of questions in Q&A. The first question alludes to something you've spoken about. So you had expressed surprise at the growth in Ghana despite the debt crisis and even an election year. And someone wants to know what were the factors that positively contributed to that growth?
That's a great question. And certainly we saw strength in services, we saw strength in industry, we saw strength in consumption. The question as an economist that occupies us is how much of this growth was actually a feature of the past fiscal excess in Ghana, what we had seen in terms of the widening deficits in 2020 and 2021. We probably don't quite understand enough about the lags with which these policy changes affect the real economy. That was certainly a part of it when a country had just come out of a high inflation environment. Let's not forget that in 2022, we saw the peak of inflation close to 55% at one point, almost reaching those levels before stabilizing again. And so the consumption boost may just be the delayed impact of all of that. But notwithstanding that, in the energy sector, in the mining sector, we think we saw some real gains in terms of production. And maybe it was the case that Ghana was just in a fortunate position all along. Debt crisis notwithstanding, there was real momentum for growth in those sectors, and this is what we saw being realized. The key question, of course, is can this momentum be sustained in 2025 against what could be a somewhat more difficult, somewhat more constrained external environment?
Thank you, Razia. I have a question. What is your view on Côte d'Ivoire, on the Côte d'Ivoire election, especially with the increase of economic performance in 2025? I think that question should go to Tim.
Yes, indeed. Well, Côte d'Ivoire has a long and troubled history when it comes to election time. So I think that there are a lot of us in our space in the geopolitical risk world watching this very closely. And there will be very real concerns that we will see violence and we will see issues with the election process, which will fundamentally undermine the trust and confidence in what's taking place there. So it's a really critical time for Côte d'Ivoire. And as we move through that cycle and that increased focus and attention upon what's happened across the wider regime, I think when we spoke this time last year, one of the key areas of focus was around coup contagion and people being very concerned that we'd seen a number of coups and military takeovers of West African countries. So what is the prognosis for that? We were quite optimistic, and unfortunately, that optimism has proven to be correct in that we haven't seen any other significant military takeovers of note in the last few months. And as we went through those key elections in Ghana and Senegal, there was certainly no suggestion that was going to materialize. But there will be questions over Côte d'Ivoire, how that plays out, and what the impact on the longer term business community is there. Of course, Côte d'Ivoire business has proved incredibly resilient in previous election cycles when there has been widespread unrest and violence on the streets and some really unsavory and tragic circumstances that have played out there. And we're seeing quite a strong rebound effect. So even if the situation looks like it's starting to deteriorate, there is optimism for the future. One final comment on Côte d'Ivoire, which actually links back to the Ghana comment as well. And it relates to a geopolitical dimension that we haven't discussed in detail yet, which pertains to the EU. We talk a lot about China and we talk a lot about the US, but actually West Africa's largest trading partner is the EU. And West Africa is the largest trading partner of the EU in continental Africa. The EU is increasingly pushing through legislation and regulations, particularly in relation to deforestation, which will have significant impacts on Ghana and Côte d'Ivoire in relation to their agricultural production, most notably cocoa. And this will have a key part to play as we move forward. So as that regulatory environment changes, both Ghana and Côte d'Ivoire will need to adapt quickly to continue on that growth trajectory. Otherwise, they will face significant impacts to those industries, which remain critical to the baseline of the economy.
Thank you, Tim. So we have another question. What are the panel's views on infrastructural projects in the region, ports, rail, roads, from a regional logistics improvement perspective? Will there still be EU appetite to support these projects?
So maybe if I come in on this in the first instance, there's obviously a great need in the region given the extent of the infrastructure deficit. But the key concern here is going to be the immediate funding environment. There had been expectations not so long ago that we would be seeing a cycle of Fed interest rate easing over the course of this year. This would have supported greater levels of external debt issuance from across the region. And now it's looking that much more difficult. We had seen some Francophone issuance over the course of 2024 as market access reopened. Nigeria right towards the end of the year, this was well received. But the big uncertainty going forward is, given the amount of global interest rates volatility, how easy is it going to be to secure this financing? What it must mean is that there's going to need to be a balancing of dependence on that financing dependence, not just looking to raise the financing from private sector entities, but the role of the international financial institutions, other multilateral development banks, is going to be key in this. As ever, the issue for West Africa and Africa more broadly remains that there is a key infrastructure deficit, but being able to finance that with ease depends very much on the global conditions that are in place. Long-term issues that need to be resolved, short-term cyclical headwinds that could get in the way of significant development. Just thinking back to Tim's comments, a critical part of this is going to be, how do we see China re-engaging with the region again? We know that in the immediate aftermath of the global financial crisis in those years, China had played a very key role in the financing of African infrastructure. And then there were concerns around the indebtedness of individual countries that had engaged in borrowing from China, and we saw something of a more hands-off approach. In 2023, we started to see overall levels of lending from China to Africa rising again, but a much greater focus on small, more manageable projects. We're not necessarily seeing the writing of the larger checks that we had seen earlier on. And a critical part of the global geopolitical equation is, does this change as China looks to secure once again much stronger levels of support from the Africa region?
Thanks, Razia. So we are seeing, I mean, on our side, in terms of deal advisory, we are seeing increased activity from China. So recently, China announced the Kano-Kaduna Railway project, and the number of infrastructure projects that we're seeing China investing in. But we're also seeing some investment from some DFIs in the EU region as well. Yeah. We have a number of questions, but I really wanted to get your thoughts, Razia, on the African continental free trade zone. It's supposed to be the biggest free trade zone in the world. But I mean, what do you see? Do you see any activity in there? I don't see that it's taking the way that it should. I'd like to get your thoughts on that.
Thank you, Finmi. Apologies, I think the line was fading a little bit there, but very briefly on the Africa Continental Free Trade Agreement. We know that this was signed at a very challenging time. It came into effect in early 2021. A lot of the land borders in Africa were still shut at the time because of the impact of the COVID crisis. There's a 5-year timetable to realize the very ambitious aim of dismantling 90% of the tariff barriers to trade within that 5-year period. And the expectation was that we would always see the critical success more towards the tail end of that period, just given the conditions that were in place at the time of ratification of the Africa Continental Free Trade Agreement. The good news is that African economies fully realize that the way forward is towards closer regional economic integration, that this is an important opportunity that has gone untapped in the past, when most of the region's trade was with the rest of the world. Of all developing nations, Africa still has the lowest amount of intra-regional trade, and that's just too important an opportunity that is foregone. But I think we also need to be realistic about the speed with which we're going to be able to bring about meaningful structural change. Talk about the establishment of a common payments platform. That is going to be very key as we see perhaps a retreat from globalization elsewhere. Maybe African economies will be trying even harder to benefit from the gains of greater regional trade themselves. It's something of an imperative, but the progress that's actually being made in this regard does require very careful monitoring.
Thank you, Razia. And then I'll go to Tim, because we've spoken a lot about oil and gas and increased investment in that space. We are seeing in Nigeria increased investment. Razia spoke about the divestments and all of that. And last year, Shell announced the $5 billion investment as well into the deep water. But how does that, how do we engage with that, the green energy transition? Because we're focusing on oil and gas in the short term, but have green energy starting to against the long-term desire to go to clean energy or cleaner energy anyway.
Yes, thanks, Finmi. And look, this is a really complicated area, and what the energy transition means to you depends very much upon where you're sat in the world. For a significant portion of the continent, the key issue is less around energy transition, it's more around energy poverty and having access to affordable and reliable energy reserves day to day. So for governments across West Africa, there is a prevailing sense that actually they need to spend more time and money and energy in investing in their infrastructure and making sure that there's reliable supplies of electricity and power both to the domestic population and also to the business community, and also a sense that they need to be afforded the freedom to exploit their natural hydrocarbon reserves for the benefits of their wider population and for their economies. So this poses a direct challenge to the stated narratives that we hear from lots of the international players and multilateral organizations, and indeed the consensus such as it is that is formed around the post-carbon world. It is extremely complicated given the immediacy of some of these issues around energy poverty and what they look like in terms of people's day-to-day lives on ground. There is certainly a question here of choosing the least worst options as opposed to choosing the preferred option. If you have domestic households that are going from burning charcoal to consuming relatively clean natural gas, that is a positive step. And of course, that needs to happen in lockstep with broader power generation that is available to the population at large on an affordable basis. So in the near term, we're likely to see most of the West African economies adopt quite a narrow focus towards continued extraction of hydrocarbons, continued development of their oil and gas sectors, whether or not they're very mature sectors like we have in Cameroon, in Nigeria, in Chad, or more emerging sectors such as that in Ghana and even more or even newer in Senegal. And we're likely to see that continue for the foreseeable future, while there is a concentrated effort and concerted focus on developing power supply for the population and of course for industrial and manufacturing use as well. The other angle to this, of course, is critical minerals, and we're seeing increased international focus and interest in securing supplies of critical minerals, and that's likely to have a positive impact in terms of investment into West Africa, as we've seen in other parts of the continent. But this needs to be managed very, very carefully, and we're all very aware of how this can go wrong and the negative environmental and social and economic implications this can have if this is not done in a manner which is in keeping with the interests of the general population, and it's not carefully kept separate from some of those unfortunate consequences that we've seen around graft and corruption and how this has played out elsewhere. So it's a complicated picture. It's not clear. It was not clear in terms of the way forward. But equally, it's very, very clear that West African economies, there is an emotional argument that many of them feel that they haven't been considerable contributors to the climate situation as it stands now, and therefore they shouldn't necessarily pick up the tab for that. They will be picking up the tab inadvertently by virtue of what we're seeing in terms of the extreme weather, the implication of demographic pressure pushing against climate factors. Indeed, the UN estimates that 17 of the 20 most threatened countries by climate change are on the African continent. So there is this complicated confluence of factors which make this a very tricky issue to navigate going forwards in West Africa.
Thank you, Tim. A lot to think about. I think the last question I'll take is one from Tim, another Tim, who is asking that what happens if the Trump-led US administration engages in the trade war with China, and how will that impact the Western countries' policy of political non-alignment?
It's a very good question. We see that there is significant scope for countries to essentially play within the middle space between the two, forming neither rigid alliances with China nor with the US, but indeed choosing to cooperate around relatively narrow sectors of shared interest, whether or not that's trade deals in the US, whether or not that's infrastructure investment, which are touched upon. And I would echo, Razia, your comment, and also for me yours. There is still a lot of interest from China, but it tends to be more focused and with much greater accountability and demands on output. So we see that there's this process of non-alignment and strategic positioning between the two will likely continue. There are, of course, other powers involved in this as well. Russia is playing an increasing role within the region in terms of military cooperation, although the economic benefits of that are widely overstated. And actually, we see the situation from a security and political economy perspective not necessarily improving across those countries where Russia has become more involved. Turkey will remain a key player, as indeed is the UAE and some of the Gulf states that are becoming increasingly important in some of these discussions. So the opportunity to remain non-aligned and to extract benefit where there is opportunity for benefit will likely remain. And we don't envisage a situation akin to that which we saw during the Cold War, where either the US or China pushes countries to align across a broad range of interests and essentially forces their hand and demands the decoupling elsewhere. Because, and a key counterweight to that is the emergence of lots of middle powers, some of which I've already mentioned, but obviously the BRICS economies as well, which can play a key stabilization role. It's no longer a question of one or t'other, it's one, t'other, or many. And that creates a very different power dynamic, which is what we believe is likely to play out across most of those economic and trade discussions.
Maybe just as a closing question, and this is to our moderator, Funmi, what you might have seen given your role in terms of local and cross-border financing opportunities.
Thank you, Razia. So briefly, we've seen a lot of interest, as I said, in infrastructure, but also in the power space. So, the first IPP in Ghana developed Italy as well with the regulation of the electricity space. So, yes. And also, always sovereign debts, bonds, PPPs. That's what we're seeing in terms of investor activity. And I think we are out of time, so I'm going to hand back to Chantel. Hello again, Chantel.
Thank you, and an absolute massive thank you to Razia, Tim, Funmi, for your informed views on what 2025 may hold for West Africa. This is really helpful for us to navigate the challenges ahead so that we remain focused on the opportunities, or actually maybe, as Tim put it, the least worst options in some cases. So on that note then, in closing, a reminder to join us on Tuesday for the North African Regional Outlook webinar. And on 30 January, Tim will also know that Control Risk will be partnering with us on a webinar to navigate digital risk in West Africa for strategies for resilience, payments, and innovation. But last, not least, I also look forward to welcoming you on 3 February in Cape Town at our 12th annual mining series. So thank you very much for your time, and thank you for being part of the Africa growth story. Until next time.